All right, so good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, June 25th, 2025, about, what is it, 7:30 in the morning or so. Okay, so fairly quiet overnight session, not a huge amount of news flow. What we do have is some sort of just comments coming out of the White House that potentially there might be some trade deals announced today, maybe with South Korea, with Japan, with Vietnam, which would be important. The market could probably like that, although it'd have to look at details. But generally, what's happening, if we look here at the VIX here on the daily chart, we can see that volatility is starting to get sort of quite low. The Middle East situation, the general prognosis seems to be that it's fragile, but the truce between Iran and Israel seems to be holding. And at the moment, the market seems to be putting its focus back on sort of the real economy, sort of macro data and macroeconomics rather than sort of geopolitics. Although, of course, Trump is in Europe at the moment, in Brussels at the NATO meeting, and we'll get onto that in a second. But just in terms of the trade deal, we see here the VIX is low. Again, if we look at the curve, just have a quick look at the curve. The curve is behaving very nicely. So we look at the VIX curve here. You see spot here at the front is down at about 17. And then you see it's in a sort of a contango structure, which indicates that in the short term, there's less sort of stress, so to speak, or need for protection or volatility compared to later months. So that's always sort of a positive sign. So that net should be a positive for sort of the stocks. As we can see, stocks yesterday reached, was it all-time highs or very close to anyway? So we see here, let me just get rid of some of this stuff here. Uh, yeah, so you can see here the stocks are not exactly all-time high on the ES, but very, very close. This is a very bullish chart, all the moving averages pushing higher. At this point, the only real question here is whether there's going to be overhead resistance or will this just pop above a little bit to test and then come down, or will it just range, or will it just keep on going? So as you can see from my comments, I don't really know. But what I can say is that the real economy does seem to be relatively strong. We potentially having trade deals. And remember that with the trade deals and the tariffs, I think the market has had 2 or 3 months at this point to absorb the information. And I think everyone seems to be settling on this idea that tariffs will come in, something like 8, 10, 12% overall. Now, is that good for the economy? No. But the point is that that pain, so to speak, will probably be shared out amongst different sort of sections. We'll have some pain from exporters, from importers, a little bit of profit margin, and a little bit of pain for consumers. So really the question then, is that going to lead to an economic downturn? And will actually any effects of inflation, come through into the economy, and B, will they be heavy enough to be sort of durable? We shall see. Now, yesterday from Powell, so I'm just going to have some tea. Yesterday, we had Powell's testimony. He's there today, but normally in these matters before the Senate, he basically says the same message as yesterday. And it was interesting yesterday. His take was essentially, and let's just look at what's being priced into the Fed. His take was essentially not that much different from last time, so fairly neutral. When I say last time, I mean last Wednesday at the press conference. And basically, what he said, just reading through his comments and listening to him yesterday, was that all things considered, inflation is still present, but it does seem to be sort of coming down to levels which is the Fed's target. So very, very slowly going from 2.5, going down towards the 2% target. So then the question is, why isn't he cutting rates if the real economy is doing quite well? And basically, his point is that they still need another 2 or 3 months data. He's convinced that there will be inflation pressures. And he basically said that in order to see the inflation pressures, they're going to have to wait for data from sort of June, July, maybe even August to get a sense of whether there are any inflation pressures. If there are they transitory or they one-offs? Are they going to be at what level? Or possibly that there won't be that much inflation pressure. And what was interesting yesterday, for the first time, he did sort of start to give a more nuanced account of pointing the way where rate cuts could be a possibility. He didn't say he's going to cut rates at this point. He's certainly resisting all of Trump's pressure, and there's just enormous political pressure on Trump. Even this morning, like a couple of minutes ago, I saw a tweet from J.D. Vance asking why Powell cut interest rates 50 basis points before the last elections when inflation was actually higher. Anyhow, so there's plenty of political pressure. But basically what Powell was saying yesterday was he is quite agnostic. I have the impression that he does believe that there is more inflation on the way, which is going to be from the tariffs. But he also did leave the door open to say, hey, if the inflation does not turn up, if we don't see significant inflation over the next 2 to 3 months worth of data, then for sure, maybe rate cuts could be appropriate. But I think reading through that, we're looking at maybe something like September. Some market commentators have said that he might wait for 2 or 3 months, but then go and do a 50 basis point cut in September. We shall see. Anyway, what's happening here is that the market took that yesterday as being slightly dovish, not because he's indicating that he's cutting rates, but because he outlined the situation in which a rate cut was plausible. So now the market's got to be very, very carefully focused on the inflation data, but I would also say on the employment data, because what's become increasingly clear, not only from Powell, but other Fed speakers, is that any hint that the employment situation is weakening, I think would give the green light for the Fed and Powell to cut. So it's almost a little bit asymmetrical towards a cut if the employment data were to weaken. But we don't have weak employment data at this point. We're going to get the next non-farm payrolls at the beginning of July, of course. So in about over another week or so. But nonetheless, the market yesterday saw just enough to think that Powell is definitely thinking of rate cuts at some point and is just trying to understand when the conditions will allow him to do that. All that to say that we now have for July, I mean, it's still only 20% possibilities but nonetheless, that was a 0% possibility. But as you can see, we're starting to build. So now in September, actually a full cut is priced in for September. And then if we look out towards the end of the year, we have now over 2 cuts. Remember, I've been talking about 2 cuts. It's now 2.4. So as we can see just on the intraday chart here, the tick chart, you can see here that this is the number of basis points priced in. So there's the 50 mark on the right-hand side here, which represents 2 cuts. But what you can see here is that, yesterday as Powell sort of spoke, and other people, you could see that we're just sort of grinding down now. So we're well above the 2 cuts at 50, and we're now into about 60 basis points. And I do believe that over the next few weeks, probably we're going to sort of alternate around 2 cuts, just maybe a little bit below, a little bit more. What would get that to 3 cuts would have to be just obviously substantially weakening inflation, and of course, probably more importantly, weakening economic data, and then of course employment. So let's keep an eye on all of that stuff. And if we were to get that weakening employment and weakening economic data, that could actually be more sort of priced in, maybe not even so much December, but maybe even September. That could go up, and maybe even October. So we might go from 2 all the way up to 3 in the next few months period. Okay, so much for that. So just getting back to the market. So what did that mean in the markets yesterday? It meant that the front end, we had a little bit of a bounce in the front end. So if we actually just look here, so all of that's good for equities. And as I was saying here, equities almost at highs. If you look at the NASDAQ futures here, just looks as though they're poking above highs. Even the Russell doing pretty well. And the idea here is that the Russell has been a laggard, but you can see that these moving averages, the 200 is flat here, but the shorter term 20 and 50 are starting to point upwards. And could it be that the Russell, which is the small cap, would actually benefit the most from potentially less sort of tariffs and a more sort of dovish Fed? We shall see. And again, we'll have to see what happens with these tariff deals, potentially with China. Sorry, not with China, with South Korea and Japan. China and Europe is still not coming to the party. And if we get favorable deals, possibly the Russell will push up a little bit higher and break out of this range, which has been in for quite a long time, actually. Okay, so let's look at that. Just in terms of what else is happening in the equities, we see the Mag 7s continuing to grind higher, but still not back at highs. So the interesting thing here is that the broad-based sort of metric here, RSP, which is equal weight, that's actually a little bit more like the Russell, but sort of generally sort of pointing upwards. So overall, the breadth is not bad, and the equities quite enjoying this current situation. Now, if we look over at, let's just have a look at global. So if we look at here, EM, so EM yesterday generally enjoys sort of a weaker US dollar. And we did get quite a weakening of the US dollar yesterday and a strengthening in your non-US currencies. So EM, that puts the balance of payment situation and debt sort of payment. It's a lot more comfortable for emerging markets. Also, commodities were down a little bit. So EM sort of pushing higher, looking pretty good. What is interesting over in Europe is that, just getting back to Trump, we have excuse me, we have the NATO meeting at the moment. And what's interesting there, apart from everything, is this idea Trump is pushing very, very hard for the European partners, well, semi-partners, to spend, 3.5, 4, 5% of GDP. We already saw Spain, which yesterday, or no, actually a couple of days ago, said that they wouldn't be able to do that, that they just didn't see the need for that and they couldn't afford it. So it's going to be very interesting just politically to see whether the other NATO countries sort of come on board and agree to spend more on defense. Now, we know that the UK and Germany have already agreed to that. We'll see a little bit with France and Italy, maybe a bit more, sort of a little bit more skeptical about all of that. But just apart from the politics, what's interesting is in terms of fiscal load and debt issuance. And we saw that Spain basically said, hey, we can't afford any more on defense. Now, we already saw that Germany has agreed to spend more. And if we just look at here, Germany, you can see here that the bunds here just starting to sort of trade a little bit heavy here. We're also seeing the same with the French bonds. But if we look at the Italian bonds, doing a little bit better here. So what's going on here is that there was a sort of announcement from the of the budget yesterday or over the last couple of days in Germany, and the bond issuance is a little bit higher than expected. So what we're starting to see here is that the yields, if we just look at, for example, the yield differential between Italy and Germany, we can see that here Germany, again, the yields going back down again a bit more, a bit even getting lower. So we're now almost getting down to that 90 basis points level again. So essentially what the market seems to be saying is that Germany is going to spend a lot. Germany is going to be issuing a lot of bonds. So the German yield curve should steepen. And let's just have a look at that. Let's have a look. So I should put all of these together, actually. I might reorganize that. But anyway, if we look at the German yield curve, you can see here that the German yield curve is starting, it's sort of flattened a little bit, but it's starting to push up here. This is the 2s to 10s. You see that's starting to push up. And if you actually see the 2s 30s here, you can see that's pushed up even a bit more aggressively. And that's basically on this idea that Germany is spending a lot on infrastructure and defense. But even yesterday, as I said, their budget was released, or the estimates for debt issuance, and that's higher than was expected. Now, there's also, just getting back to France, we can see here that the French yield could just slightly go up a little bit. Now, this could be on increased defense spending, but also there's domestic politics that the current government of Bayrou could be toppled just because the left wing is unhappy with some of his pension reforms. And long story short, there could be sort of instability in French internal politics. And I remember last time we had that, we had an election which was disastrous, and it was very difficult to find a coalition partner. And basically, the French bond yield went up just on political instability, internal political instability here. So that's something interesting to look out, just to see here whether the French OATs, the yields will go up, and possibly even compared to the Italian yield, which everyone seems to be in love with at the moment. If we just go back to Italy, the Italian internal political situation seems to be relatively stable. And you can see here that the Italian yield is actually sort of trading, if anything, the trend has been sort of downwards. So I'll be looking also at the Italian and the French sort of spread. So at the moment, the Italian over France is about 25 basis points. As you can see, that's come down a lot over the last year or so. It was over at 100, 120 basis points. So that just continues to get lower and lower. And if we go back on a weekly chart, we can see here that this is getting to sort of historically very low levels. So you can see that, at some points in the past, this has been up to 400 basis points. And here we are now at only a quarter of a percent, so 25 basis points. So very, very low levels here, going all the way back, actually not exactly the lowest, but we're getting to a point here where this could go down a little bit more. But if it breaks down there, that we're in really uncharted territory. I'm almost getting down to parity here. So that's quite an interesting chart to be looking at. On the other hand, we had Le Pen this morning saying that she was in no hurry to topple the government. So maybe that instability will not turn up. But quite interesting there looking over in Europe. And generally what seems to be happening is that the Italian seems to be behaving a little bit better than the French, which seems to be behaving a little bit better than the German at the moment. And of course, that's against historical precedent. So that's quite interesting situation over there. Okay, let's have a look at oil. Well, actually, just look in the US, not a huge amount happening in the US. As I said yesterday, you can see that just on those Powell comments, you see the front end of the curve here. So this is the 2-year, the ZT, pushing higher, just on the slimmest of sort of feeling that maybe Powell slowly is getting closer towards sort of restarting the cutting cycle. So the 2-year just sort of pushing its way up, the 5-year also. But as you go out towards the longer end of the curve, you see the longer end of the curve not as much, and that's just because inflation is still a concern. And remember as well that the less aggressive the Fed is in combating inflation, that means that for a long-term bond, which is very, very sensitive to inflation, it means less tough medicine for inflation. And therefore, net not perfect for the long end of the curve. So again, we're seeing a bit of a sort of a steepening in the curve, not dramatic, but like the 5s, 30s, the 10s, 30s have been steepening quite a lot. In terms of the short-term interest rates, also interesting to see what's happening here. If we look at the very front of the curve, which is for September, you see that's starting to push up in the SOFRs here. And then the further out we go, so you go sort of December of 25, pushing out. And then if we go out to September 26, you see it's even pushing out a little bit more. So quite, the front end of the curve definitely thinks that the Fed is up to something. Okay, let's looking at oil. We all know what happened after, the sort of the ceasefire with Iran, Iraq. So Iran, Israel, my apologies. We can see that oil came down about $14. So at this point, it's interesting just from a technical situation. So if we draw a fib line going back from May the 5th all the way up to here, you can see here that we're now at a pretty critical level. It's the 61.8 fib retracement level. So if the oil market wants to bounce, that's not a bad one. We also have, as you can see, a lot of congestion here along about that sort of 63, 75, 70, $64 mark. So this is not a bad place for oil to make a stand. But on the other hand, there's no reason why it can't keep on going down. But my spidey senses are telling me, although that's not very quantitative, that this would be a chance for stabilization. So at this point, still, this a lot of technical damage has been done to the oil market. I'm not expecting this to bounce viciously unless, of course, we get some kind of geopolitical event. So let's just see what happens over the next few days. Let's see if we start to form a basing formation, maybe maybe something like, this will sort of happen, just putting on a bit of a ghost feed will sort of, and then maybe the oil market can sort of stretch its way up. But anyway, I'm just saying I'm watching that 61.8 fib retracement level, which seems to be at 64.20 on the front contract. Let's keep an eye out for that. Also, there's a bit of an uptrend line there, which I'll just put on which could be a bit of support. So let's see if it holds this uptrend line and see what's happening there. So that's about it. Just in terms of currencies, we did have the dollar yesterday having a pretty sharp reversal, again, just on that geopolitical risk. So interesting just to consider that now that the dust has settled. So we did see the dollar rally on geopolitical risk. So for a lot of people saying that, the dollar was no longer sort of a safe haven, that doesn't seem to be exactly the case. But now that we've got that geopolitical risk is a little bit more sort of tranquil, that situation, you can see the dollar here is resuming its downtrend. Again, it's at the dollar index here is at a pretty key level. You can see here this level at about 98 is absolutely key. It's a horizontal support. Let's see if it can hold that. But as you can see here, all the moving averages, the momentum is still pointing downwards. If we look at some of the major cross pairs, we can see that the dollar against the euro, pretty strong, but again, the euro just up at highs here at 116, just taking a little bit of a pause. And nothing dramatic at this point, but probably really what needs to happen, we need to see some active bad news or some dovish news coming out of the US in terms of interest rates or lack of Fed independence or yields going down or weak economic data or something. We need to see something here, maybe to give the euro another push upwards. Similar situation here if we look at the yen. You can see here that the yen actually was strengthening against the US dollar, but we can see here that up today about 50 basis points, the US dollar again. So just in a sideways pattern at the moment, probably just waiting for a bit more information. Let's see what happens with Trump at NATO. We have Powell again on the Hill today talking about the Senate. We do have a 5-year bond auction coming up, which is expected to go well. We also have oil numbers today. We had last night oil inventories. So apart from that, not a huge amount of data. And we probably will have to wait until the first week of July, which is about a week away, to start getting another heavy dose of data. I mean, at the end of this week, we do have PCE and GDP readings, so that'll give us something. But today, ordinarily, not a huge amount happening. We'll see what happens. Okay, thank you, guys. I'll leave it there. Have a great day. We'll keep the conversation going. Thank you.